Hello and welcome back to Co-Founder Chats with Alex and Ryan. We're going to continue our conversation about funds this week, kicking things off for part two, investor-specific questions. Alex, why do investors choose to invest in private funds?
Well, there's a number of different reasons why someone would choose to invest in private funds, but generally, private investments because they have less reporting requirements, there's less liquidity and things like that, which are increases to the risks. They generally also can potentially provide higher potential returns. And so this creates an opportunity for people to access investments that they wouldn't be able to access directly through a public fund, more easily through a private fund, and also potentially increase their returns. If we think about a standard mutual fund, for example, a standard mutual fund is able to invest in a public standard mutual fund is able to invest in public equities like stocks and bonds, and they can do that in stocks and bonds that are also listed in the stock market. They're typically not allowed to invest in private companies or private debt, and they're typically not able to actually go out and invest in certain types of derivatives and certain types of sort of puts and do different types of sort of more complex, higher potential risk derivative strategies. So these higher risk options are sort of off the table for your standard public mutual fund. A private hedge fund, for example, that does trade in public markets is able to make use of all variety of available financial instruments, including all different types of derivatives, and use them in much more complicated strategies. They're also able to invest in private companies as well as public ones, so they can provide a broader range of financial assets and investments available to their investors. So that's sort of one reason. Typically, to sum it up, it's really to get access to potentially higher returns, but it does come with some risks.
Okay, excellent. And who are the types of people that can invest in private funds?
So the types of people who can invest in private funds, it's been changing recently. So traditionally, private funds were only able to raise capital from high net worth individuals who are called accredited investors. Essentially, private funds are another type of private company, and all private companies are regulated when it comes to capital raising, just like public companies are. Private companies, the way they're regulated and the way the rules are set up, essentially the standard process for any company to raise capital would be to go public and create something called a prospectus, which is a document that companies create when they first go public. Now, for a company to stay private and raise capital from investors without going public, they have to use some different legal rules, which are called prospectus exemptions, essentially rules that allow them to raise capital without needing to prepare that large prospectus and go public. There's a number of different prospectus exemptions available for any type of private company, but funds, specifically because they have an individual managing and controlling your money, have greater limitations. Essentially, the standard set of rules for most private funds that they've raised under for a long time would be what's called the accredited investor exemption. And this exemption allows private companies to raise money from high net worth investors called accredited investors, and they can raise any amount of money without needing to take on ongoing reporting. So essentially, for a long time, private investments like this were really restricted to high net worth individuals. There is another exemption that funds can take advantage of called the offering memorandum exemption. This exemption allows private funds to raise capital from not only accredited investors, but also what's called eligible investors, which is basically an individual who has income or financial assets, but not to the same extent as an accredited investor, or the category of people which are referred to as non-eligible investors, or on Equivesto, we call retail investors. And these individuals would not have any sort of specifically set income or assets. Now, all of these people would have to live in Canada for these securities laws to be applying. But what's important to note is using the offering memorandum does have maximum raise amounts from these individuals who are not accredited. Also, it's most typically done where a fund raising through an offering memorandum would actually work with an exempt market dealer like Equivesto or others to essentially help facilitate and complete those transactions, where the exempt market dealer does review every investor and helps them with know your client and suitability, and essentially confirming which different investor type the investor belongs to. Because eligible investors are limited to $100,000 per year total in all offerings raising using the offering memorandum exemption, and non-eligible investors or retail investors are limited to a total of $10,000 per year, again, for all offering memorandum based capital raises. So the offering memorandum does allow private funds to access more individuals. It just comes with a few additional pieces of work. Raising under the accredited investor exemption, you're not going to need to necessarily provide a ton of additional paperwork or anything like that. As soon as you switch to the offering memorandum, you have to prepare a document called the offering memorandum itself, which is 70 to 100 pages and quite detailed. You have to provide audited financial statements as part of the offering memorandum and as well on an ongoing basis. And you have to provide some annual reporting to the regulator on your use of funds and how many investors you have and a few things like that. And so it does sort of move you to nothing sort of as extreme as going public or anything like that. You can still operate as a private fund, but it does sort of add some additional oversight to give a little bit more protection to those general public investors. Now, in a few select provinces, there is a new exemption that they're sort of testing out, which is called the self-certified exemption. So you could also use this exemption to allow investors to participate. And essentially, this allows people with certain financial or educational knowledge or requirements to be able to invest up to $30,000 per year into private deals using the self-certified investor exemption. Again, they have to undergo a know your client and suitability process as well. You can look at the definitions of all these different investor types and documentation that they need to support their qualification as that type of investor on the Equivesto website in our Learning Center. But essentially, most private funds typically raise from higher net worth individuals. When you're doing all this paperwork and everything to allow somebody to participate, the more money that one person invests just allows you to sort of maximize on the effort you're putting in to allow that documentation. But part of what we're trying to do is make that more accessible for everyone by reducing that sort of paperwork and documentation burden along the way by digitizing the process.
All right, perfect. What are some of the types of private funds?
So we talked about this a little bit before, but there's a whole different group of private funds, sort of depending on the way and the type of underlying asset that you want to invest into. So some private funds really focus on investing in the public markets, but using more complicated investment strategies that include derivatives and other sort of more interesting financial instruments. And these would be called hedge funds. There's a number of different strategies that hedge funds can use, sort of generalized strategies, but essentially hedge funds are looking to still play in the public stock market, but leverage their additional sort of knowledge and capabilities to do more complicated things to potentially earn greater returns for their investors. Another example of a type of fund that would invest in the public markets would be a quantitative fund or a quant fund. Essentially, these funds use extreme sort of supercomputers doing very complicated calculations to try to sort of predict the market and make trades in advance of sort of other people. They typically try to locate themselves physically closer to the stock market they're trading on. So their internet connection is that much stronger, and the time it takes the electron to move from their supercomputer to the server of the trading floor is physically shorter, so it gets there faster. So they're really trying to trade as rapidly as possible and as quickly as possible and use complicated algorithms for that trading. Now, there's some other types of private funds that are not focused on the public markets, and instead they're focused on the private markets themselves. When you look at investing into private companies, there are venture capital funds, which sort of are the earlier stage professional funds investing into these private companies. So a VC fund would invest in early stage startups, not necessarily all small businesses, specifically startups. So these are high growth opportunity, highly scalable early stage companies that typically have at least $1 million in revenue, is pretty standard for your average VC. And they would focus on really helping grow these companies very quickly. So they're looking for these early stage startups. You'd also look at private equity funds as larger private funds investing into private companies. Now, some private equity funds are even public, so publicly traded companies, but many private equity funds are also private funds. Now, private equity funds can invest in private companies in a few different ways. Some private equity funds are focused on kind of continuing the journey that the venture capital funds started. So essentially, they're looking at investing in those kind of high growth, high potential, technology-driven startups that they're going to keep fueling rapidly, and then that'll lead to a sort of later stage IPO where that startup goes public or something like that. And they're really interested in sort of ramping up that growth. Some other types of private equity companies are focused on buying and operating successful private businesses. So, you've always heard the story of kind of the boogeyman of there's a sort of family operated business that's been running successfully for 20 years, and then they get bought out and the new investors come in and they like fire half the team and they kind of are like all about nickel and diming people. That would be a sort of overly exaggerated example potentially of a private equity firm. So these private equity firms specialize in essentially operating and finding efficiency in a variety of private businesses, typically in generalized sectors. So they would be looking for a group of companies in the financial services industry where they can find ways to kind of have them all work together in a symbiotic relationship, and then slowly go around buying already successful private companies to sort of add to their stable of businesses. Now, putting aside investing in these different types of private businesses, some other types of private funds really focused on real estate. So with any type of real estate investing, there's really going to be sort of three main ways to invest in real estate, whether sort of public, private, investing personally, doesn't really matter. The three main ways of investing in real estate. The first is as any sort of development focused investment. And so really with development, you're taking land that does not yet contain a building of some sort, whether commercial or residential or anything, and potentially even industrial, and you are paying to help turn that land into a full building. So if it's totally raw land, it might be rezoning the land, getting it surveyed, and then actually going out, hiring construction teams to actually build the building that's been designed also by architects that you've hired. So that is creating new buildings, bringing them to the market, and that would be a sort of development-focused real estate fund. So there's a number of different real estate funds that sort of focus in that. Another type of real estate fund would be a more standard real estate investment trust, or a REIT. REITs are also publicly available for investment. So you may have heard the term REIT before, but essentially a REIT is looking to buy existing buildings, typically apartment buildings, but there can be commercial REITs as well that buy office space. But typically they would buy an apartment building that's already operating, and they'd be looking to just continue operating that business. So they would hire a management company to come in, rent out the different apartments in the building, and they would be focused on making sure that the money, the proceeds from the rent is greater than the costs of operating the building. And that difference would be typically an annualized return from the REIT. So this is really a cash flow focused real estate investment. And at the core, if you think about any sort of profitable business, the idea is you own an asset that makes you money and you benefit from that money long term. So this sort of REIT model is probably the most standard real estate investment model. The people building the new buildings on the developer side are building buildings that either get bought directly by individuals or become sort of operated in this sort of way by other real estate funds. The third opportunity to invest in real estate leans a little bit more towards really taking a chance on price increases in the real estate space. Now, when you're buying a building and you're operating it, renting it out to tenants, like in that sort of second category, there is a chance that that building will go up in value over time. So usually REITs will combine the majority of their return as a sort of cash flow based return. So you're earning, 5, 7, 8% every year as sort of your slice of what's coming in from the tenants, with another few percent coming potentially from the increase in value of that building. Now, this final category is a little bit more focused on speculation. And so in this category, you're buying a building that is not currently making enough money in rents to cover the costs of operating the business. So it's actually the building itself is cash flow negative. You have to put money in every month to sort of keep the business going. But the market itself is so sort of hot and excited that the expectation that that building will still continue to go up in value is what's driving people to participate. And so when you're looking at real estate investments, it's important to understand sort of which of the three you're getting involved in, and you understand the risks, because you can certainly make money in each of them, but they all carry different risks. There's sometimes different models that are a little bit hybridized. So you will see some real estate investment opportunities that are focused on a little bit more flipping. So essentially they buy a building that may be cash flowing, may not. The focus isn't necessarily the cash flowing, but then what they're doing is focused on potentially, if it's a single house, renovating that house, really improving it and sort of raising the quality of the house, and then trying to sell that house for a lot more than they paid for it, plus the cost of the renovations. Sometimes you'll see REITs focus on buying a building that's underperforming relative to other buildings around it, wherein it's a little bit older, the building's in a bit of disrepair, and their rents are a bit lower as a result. And then they would buy the building, fix up the building, and then bring rent sort of in line with those around them. This is where, you might see people talk about renovictions, which is sort of doing a renovation to increase the price and therefore evict the previous tenants, which some people don't like very much. But there's sort of all these different sort of subcategories of real estate funds that exist. But primarily, if you're looking at funds in real estate, you're either going to be sort of focused on the development of new properties, which is high risk but high potential return, because you're really taking a chance that they'll be able to actually build and execute that new building. You've got buying a positive cash flow building and just continuing to rent it out. So that's more of a REIT style investment. Those are a bit lower risk, sort of a little bit more standard. And then you have sort of a little bit more speculation on the market. Those are potentially the highest risk, but they can, if markets are really hot, make really high returns in short periods of time. But again, there's risks associated with that. Now, not necessarily a real estate fund, but also associated with a way to make money investing in real estate, which is worth mentioning, would be a MIC, or a mortgage investment corporation. So a MIC is essentially a company that, like a bank, is a private mortgage lender. So essentially people would come to the MIC, and the MIC would actually underwrite mortgages. So they take all the money from the investors and they use that money to give mortgages to people that those people can then go and buy the houses, and the MIC gets the underlying title on the property until the mortgage is paid out. And similarly to the REIT opportunity, the MIC just generates sort of consistent annual returns for their investors as, people pay off their mortgages. And really the important thing to keep in mind with MICs is paying attention to the loan to value. So the loan to value is essentially how much money are you giving to the borrower? How much money are you giving to this person compared to the appraised value of that property? So if you have a $1 million house and you take out an $800,000 loan in your mortgage is an $800,000 mortgage, that is an 80% loan to value. So the higher the loan to value, the greater the potential that the person is not going to be able to pay the mortgage back, and it'll take them a long time to pay the mortgage back. And if, most importantly, there's any change in the value of that house, then the house could become underwater. With the MIC, the one thing you want to avoid is you give out a $1 million loan to a person secured by a house, and then the house becomes worth less than $1 million. So even if the person couldn't pay you back, so you got the house and then you went to sell it, you would be able to sell it for less than you lent out in the first place as the mortgage. So that's kind of the greatest concern for MICs. You'd also want to think about whether it's a sort of primary or a secondary mortgage. So you want to know whether you're the first lender, and so when the house gets sold, you get your money back first, or whether you're coming in on the second mortgage. So the first mortgage gets paid out first, and then you get paid out from what's left. So those are sort of two things to keep an eye on. MIC is a mortgage investment corporation. It's not a fund, but it is a way to invest in private real estate. So I wanted to make sure to mention it here.
All right, perfect. Thank you. Jumping back to your what you mentioned about venture funds, what's the difference between a venture fund and an angel syndicate?
That's a great question, Ryan. So the core difference between an angel fund and a venture syndicate, a venture fund and an angel syndicate, is really the actual use of capital and who's making the decision. So with an angel syndicate is essentially an additional structure, an additional company that's created for all of the angel investors to invest into, and then have that money as one big sum invested into an underlying company. So what that does is it combines potentially some smaller angel investment checks into one location. It gives the angels a little bit more negotiating power with the company and makes everything a bit easier on the company side. So, in their ownership table, their cap table, they just have one line, which is this angel syndicate. So the key with an angel syndicate is the underlying company is already known. You're signing up, you're coming to invest in this company. That company is the one that's pitching you. And then your investment just happens to flow through this syndicate and structured, through the syndicate. But very clearly the underlying company, the terms of your investment into that underlying company, and all of those details. With a venture capital fund, there's an additional layer where you're investing into a fund and you have the principals of the fund going out and actually choosing the companies. You don't necessarily know what companies are being chosen. You're not really involved. The principals of the companies are going out, choosing those companies for you, choosing the investments, making the terms. There's somebody involved whose professional job it is to assess and pick which companies that fund should invest into. So from a venture capital fund perspective, there's potentially a bunch of improvements. You have professionals involved choosing the right companies. You as an investor are also getting exposure to a lot more companies than you were. Like in a syndicate, you're just investing in the one company, but investing in a fund, you're investing, and that's going to a lot more businesses because the fund is going to go out and invest in a number of different companies. One challenge with this, though, is of course you are paying those fund managers fees for going and managing and doing all this work for you for 5 years. So there's sort of a good and bad scenario, not necessarily good or bad, just sort of differences in the types of investment depending on sort of the way that you would choose to invest. So with a venture capital fund, There's some professionals involved who are going out and investing the big pile of money that they've raised into the fund into a number of different businesses, whereas the syndicate is into that one business. Also, in terms of timing, the venture capital fund is going to raise their money sort of at the beginning of the fund. They're going to get all the investment documents from the investors signed, typically before any investment that the fund is going to make is known, because they need to have the money first before they can make any investments. So the fund will go out, raise the fund, do a nice big press release saying, hey, we just raised, VC Fund 1, we raised $50 million. We're now going to go out and invest in fintechs or crypto or whatever it is they're going to invest into. Whereas with an SPV, the company is already typically out raising money. They've pitched some angels, and the angels say, okay, we're interested in proceeding, but we're all going to kind of group together and invest as one into your company. So the company's already known in advance, and you're structuring the syndicate to really take in the investors with all those terms clearly outlined.
Okay, excellent. So who are private funds not for?
So private funds, like with any private investment, are automatically higher risk because they don't provide the same liquidity. You can't sell your investment whenever you like. They don't provide the same reporting or information. They're not regulated in the same way. So automatically, private funds are only for people who are sort of willing to take on more risk when it comes to investing. The next thing we need to think about is what set of rules is that fund raising under? So I did talk about previously that accredited investor exemption, and I talked about the offering memorandum exemption. Now, I will note syndicates, the angel syndicates that I mentioned, can use that sort of SPV structure that we've talked about and a few other sets of rules. But really for funds, we're going to focus on sort of the more standard accredited investor or offering memorandum structures. So if the fund is only raising using the offering, the accredited investor section paperwork, then the fund is really only available to accredited investors, high net worth individuals. And typically, the minimum investment is going to be quite high, $50,000 or $100,000 per person into the fund. And typically, if you're only raising capital from angel investors and accredited investors through the accredited investor set of rules, then they're not going to include additional work to make sure the fund is TFSA or RRSP eligible. Now, if the fund is raising using the offering memorandum exemption, they've done some additional work to help make the fund a little bit more accessible and possible for the general public in Canada to invest into the fund. So the fund has annual reporting, they've got audited financial statements, and they have the offering memorandum itself to sort of provide additional comfort and security for the investors to allow themselves access to a broader range of potential investors. So funds using offering memorandums can technically allow very, very small investments, even as low as $100 or less if they really wanted. Now, again, it does come to the amount of paperwork and other things involved. So typically, funds raising using the offering memorandum exemption are doing that to allow the eligible investor category to participate. So individuals still need to have a certain income or net financial asset range that they need to hit. And they're still going to be investing larger amounts of money, but it allows a lot more Canadians to participate who are not accredited. So what we typically see from funds raising using the offering memorandum exemption would be they're doing that to allow eligible investors to also participate. So those are individuals with 75,000 in annual income, or 125,000 when combined with a spouse, or 400,000 in net financial assets, or $1 million in total net worth. And this sort of combination typically comes with a minimum check size, a minimum investment around of 50,000 or sometimes $25,000. Now, funds themselves, certainly ones that want to be structured as a mutual fund, have a minimum number of investors that they need to have in the first year when they're sort of getting the fund set up. So there may be instances where smaller funds, when they're just getting started, will reduce that minimum investment amount to something much lower, maybe even $1,000, to allow the non-eligible investors or retail investors to participate for a limited time to help them reach that minimum number of investors that's required to really qualify as that mutual fund. So that's one thing that you might see, and that could be a good opportunity if you're willing to take a bit of a chance on a newer fund for some smaller investors to get access to these private funds. Some funds that already have well over that number of people are focused on improving their accessibility to investors of all backgrounds. And so these would absolutely be using the offering memorandum exemption, and they'd be allowing investors to invest typically from, a $1,000 amount, and they would allow non-eligible or what we call retail investors to participate because they're actively trying to improve accessibility to this higher potential risk, but higher potential return investment asset for the general public in Canada.
Thank you. All right, I'm interested. So how does the investment process actually work?
Yeah, so the investment process for funds is a little bit different depending on the type of fund. But I'm going to start with what we'll call the sort of most standard private fund. I'll use a venture capital fund as an example. So you've spoken to the fund managers, you've spoken to the sort of leaders, the principals of the fund. They're raising a fund, you're interested. So what actually kind of happens now? So typically there's going to be a date of closing where that's sort of the last date that the fund is taking in money. When you first confirm that you're interested, you'll probably sign some documentation in advance of the official closing. You'll probably sign a subscription agreement to sort of say, yes, the subscription agreement is the agreement where you're agreeing to purchase the units. So funds don't issue shares like companies do, they issue units. So you're agreeing to purchase the units of the fund, and it's going to outline, when that purchase takes place and things like that. You will also sign a limited partnership agreement. So funds are typically structured as limited partnerships where there's a general partner that sort of runs the fund and has unlimited liability. And then there's the limited partners who are basically all the investors, and they don't have any control, but the focus is on them putting their money in, and then they're getting the returns back out. So basically the limited partners put in the money and the general partner manages that money. So you would sign a limited partnership agreement, which outlines really the ways in which the general partner can use your money and what they're going to do with it and the timeline and everything like that. So those are kind of the two main documents you're going to be signing. When you're signing the subscription agreement, there's also going to be some sort of required risk acknowledgement forms and things like that, depending on the type of investor you are. Now, for a standard venture capital firm, they may raise all of the money upfront and have that happen as part of their closing, where you actually give the money to the fund at that time. So they're raising a $100 million fund, and boom, one day their account suddenly has $100 million in it. Or what happens more likely with the larger funds is there's going to be a series of something called capital calls. Capital being money, and call is the fund calling on you to provide it. And so that basically allows you to agree to provide the fund a certain amount of money, potentially, $5 million. But if the fund isn't going to need that $5 million all up front, you're able to keep that invested somewhere else or in GICs or wherever you want to keep it. And then you only have to provide it to the fund when that capital call takes place. Now, that works really well for venture capital funds because the fund is going to happen over a series of years. The managers of the fund can't necessarily go out and find all the companies they're going to invest into, maybe 20 or 30 companies really rapidly, over the course of a week, once they have this $100 million fund. Potentially what they do is they'd say, okay, we're going to raise it. We're going to have a series of capital calls at 25 million. So there's going to be 4 capital calls over the life of the fund. And we'll start with the 25 million. We'll go out, we'll make $2 to $5 million investments, and then we'll do our next capital call once we deployed all that money and we need more money to then go out and deploy. They'll also potentially save some of that money to reinvest into some of the earlier companies that they had invested into later on in that company's life. And so some of these funds will be structured with these kind of capital calls. And part of what your responsibility is as an investor in these funds is to know, okay, when these capital calls are, and to make sure the money that you promised and signed the agreement on would be available at that time. Now, that's the sort of specific venture capital call method. For most other funds, it's going to be just pretty standard, like investing into any sort of private company. So they'd be raising money, sign the investment documents, you'd provide the funds, and then the closing would take place. Now, if you're investing in a private fund through a platform like Equivesto, for example, there would be two different types of private funds, two sort of categories, ones that are sort of limited in time and what we'll call sort of closed-ended funds, and ones that are going to last a long time and we'll call open-ended funds, and will be raising capital for a long time. So with a closed-ended fund, if we use real estate as an example, remember we talked about real estate development funds. So they're raising money to build a building, they're going to build it, and then they'll sell the building at the end. With a development fund, there's a limited time that they need your money. They need to take your money, build the building, and then they sell it. And when they sell the building, they close the fund down. So with the development fund, they're raising all the money sort of upfront. You're going to sign up on Equivesto, get your account approved, you'll sign the investment documents, and then you'll actually move the money that same day. The funds are going to be held in Equivesto's segregated trust account until the next closing. There's typically a closing once a month for some of these funds, but make sure to read the details on the offering page to confirm when the next closing is. And then when it closes, the funds will then actually move to the fund from the trust account. So the closing will happen sort of once a month basis. None of the closings for private investments are immediate. So for example, if you're investing in something in the stock market, because it's trading all the time, you make your investment and the investment sort of gets deployed that same day or the next day, where, okay, now you actually physically own that stock or that mutual fund, and now it's immediately making you money. With private investments, every time all the sort of money goes in and actually exchange the money for the units or the money for the shares, that's called a closing. And there's a bunch of paperwork associated with doing that. And so typically closings are not done on a continuous basis. They're done typically once a month or once every 6 weeks or something like that. And so in that scenario, when you make your investment is secure and locked in. The platform will collect the funds and hold them in a trust account, and then they'll sit there until the closing takes place. And then when the closing takes place, that's when the money actually goes to the fund, to the investment, and things sort of get underway. So with a private real estate fund that's focused on development, they'll be raising over a number of months, typically with a closing at the end of each month. And then they'll have a raise target, and eventually they'll hit that raise target, or the time that they've allocated for raising will expire, and then they'll stop raising money. They're not going to raise any more money. They don't need any more money. They have invested in all the different buildings, and then we'll all just sort of wait. And then, 5-6 years down the road, whenever the fund is scheduled to end, the fund will basically get all the money from selling the buildings and then send all of those profits back to their investors. These development funds typically won't raise multiple times or be continuously raising during the life of the fund. Now, if we look at that sort of more standard REIT model, where basically the real estate investment fund is buying a number of buildings and they're just renting those out, and the money they get from the rent after paying expenses is what's generating your return. These would be called open-ended funds, in that they're continuously raising money and people can invest into them sort of anytime, and they're always going to be open, but they're also never going to sort of shut down. The idea is they last a very, very long time, and you take your money out through something called redemptions, which we can talk more about in a moment. But with these types of funds, the same thing. There's going to be monthly or every 6 weeks an official closing that takes place. So you make your investment, you sign the paperwork, you move the money, It sits in the trust account, and then when the closing is declared, then that money is sent to the company and actually exchanged for the units, which are then issued in your name, and that's when you'd start generating returns. So there's typically not capital calls in these types of funds. Typically, capital calls are for venture capital funds or other private funds where they're making sort of specific large deployments. But for very, very large real estate development projects, you may see a capital call structure. If they're building like $1 billion business building or something like that, a very, very large building, then potentially they're not going to ask for, the $1 billion up front. They'll have it in tranches. And so then they will use that capital call structure. But smaller development funds typically wouldn't do that.
When do I get my money back?
Straight to the point. I love it,
Yeah.
Ryan. Yeah. So this is probably one of the most important questions that people would ask when looking at or considering investing in a fund. Like, when do I get my money back? Sort of how does this all work? So again, with a typically sort of closed-ended type fund, so think venture capital fund or real estate development fund or something like that, think about sort of what's actually being done with your money. You're giving your money to the fund. The fund is going out and buying something or investing in something. Like if it's a development fund, they're physically building a building. If it's a venture capital fund, they're investing in a bunch of different startups. And then they're really kind of managing that process. So if it's a development, they're running the teams, they're sort of coordinating, making sure that the building's getting built over a number of years. If it's a venture capital fund, they're helping those startups grow and sort of expand and increase their size as quickly as they can. And then at the end, near the end of the fund, there's going to be some sort of moment where that fund sort of gets its money back. And that is often called the exit. But in a development project, that building would be finished. The condo building is done. So now they sell the condo building. So they either sell the individual units or they sell the whole building to somebody else who's going to then sell the units. There's a few different ways, but essentially they sell it all at the end. And so then at the end, there's going to be a whole big pile of money sitting in the fund's bank account, and that's when they distribute it out to the investors. So even though the fund may have posted a targeted annual return when talking about, what they're hoping to do over the life of the fund, for a VC firm or a real estate development fund, there won't actually be any money entering your bank account, and you won't see a change in the value of your units of your investment in the fund. You won't see a change in value. So you won't be like seeing it go up and up and up like you would see a stock in the stock market change. It's going to be totally flat. You're going to see nothing happen for basically 5 years. And then suddenly you're going to get a huge pile of money at the end, hopefully. So that's the sort of timing and the structure you typically see for a closed-ended fund like that. There's going to be nothing. They're going to go out, spend the money, do a bunch of things with it. And then there's going to be, as they wind down the fund, there's going to be a big sort of exit and return of your funds at the end. Now, with other types of private investments, let's look at a sort of open-ended real estate fund as an example. In this scenario, the fund is investing in buildings that they're renting out to people, like an apartment building, and those people are paying rent. And that rent is making up, the majority of your returns. And so in that scenario, you will be seeing distributions, as they're called, essentially money coming from the fund to you on an annual basis, or maybe even a quarterly or a monthly basis. So just basically whenever the rents are being paid out, and depending how the fund is structured, you're going to be getting these small payments of essentially like interest or a dividend or however it's structured to your account. Now, some funds allow something called D.R.I.P, which would be distribution reinvestment program or plan. Essentially what this says is, okay, instead of us paying you out that 8%, what you can choose to do is have us hold on to that annual return and then reinvest that for you. So we'll buy more units of the fund in your name at the current price that the units are being sold for. So the amount of money that you have generating that percentage is growing. And this is where you can really start compounding your returns. So if an investment is promising you an 8% annual distribution, And instead of you taking that 8% and buying some ice cream, you take that 8%, that'd be a lot of ice cream depending on your investment, but you take that 8% and use it to buy more units. Now, instead of $100 you have invested, you have $108. And then that $108 is going to generate 8% and sort of on and on. You don't get that sort of compounding with a closed-ended fund because you don't get any money out for 5 years. Now, closed-ended funds are higher risk and typically are generating much higher returns than you would get from a sort of cash flow generating type investment because of the nature of the investments. But with a sort of real estate fund that is operating buildings and generating this sort of continuous return, you're going to be getting that cash flow. Now, sometimes the funds will talk about earning you a range. So they'll say, oh, 8 to 12% annually, and then they'll talk about what the distribution is, and then there's some other return that's potentially variable. And that variable return is not a return that you're actually going to see as a distribution. That's basically trying to account for the increase in value of the underlying buildings that the fund owns. Now, the only way you're ever going to see that potential return is when you actually go to get your investment back out. So with a private fund that doesn't allow any sort of trading, you can't go and sell your units in the fund to some other investor. I can't say, hey, Ryan, I invested in this private real estate fund. It's done well. I've got some good returns from it, but I'm done now. I want to, get out. Would you like to buy it from me? You can't really do that. The only way to sort of get your money back out if the fund is not shutting down is through something called a redemption. And that's basically when you go back to the fund and you force them to buy your units back from you. So many different funds have redemption clauses, but it's important to read the details, the fine print of the redemption clause, because typically, even for an open-ended fund that sort of renting out buildings and you're earning your money based on the rental income, the redemption clause is essentially going to have a bunch of fees, higher cost eventually getting smaller to stop you or try to discourage you from redeeming earlier. So when investing in a private fund, you almost always want to assume that you're going to be locked in for at least 5 years. Now, many of these funds do have redemption clauses, and it's going to be different fund to fund. But you want to make sure you understand the details of the redemption clause, what the penalties are and sort of what that looks like. But really, when you take your money back out, depending on that redemption price or how that redemption price is set, that is good where you're going to see that potential additional percentage in the annual return. So if the fund is offering you a standard 8% annual distribution plus potentially 4 to 6% in growth, really what they're saying is we're renting out these buildings, they're going to generate you 8% per year as a return, and the value of the buildings might increase 4 to 6% per year. So eventually down the road, when you sell your underlying units in the fund, because the fund owns more buildings and everything, and the buildings have gone up in value, you may see the price of the unit has gone up by the equivalent of 4 to 6% per year. But if the price of the unit has not gone up, if the redemption price when you try to take your money back out is the same as the redemption price and as the purchase price when you initially bought the units, then you're not going to get any sort of 4 to 6% growth. It's just going to be that sort of consistent 8% return that you earned every year until you decided to redeem. So as an investor considering one of these sort of real estate funds, it's important to understand, okay, what type of fund is it? Is it a sort of closed-end development fund where my money is locked away, it's buying a building, there's no distributions, but then there's going to be a really big potential payout at the end? Or is it more of a sort of REIT-based investment where they're buying buildings, they're renting these buildings out, and I'm getting money from the fund on an annual basis with a small potential increase in value if the buildings go up? Depending on what type of fund you're investing in, you need to understand, okay, when am I potentially getting my money back out? Or when do sort of the redemption fees drop off when I can actually redeem it without paying penalties? is there fixed redemption price? Is it floating? How is that kind of calculated? And what are the distributions going to look like, and how are those paid over the life of the fund until I decide to redeem? So these are a few different things that you really want to think about if you're thinking about investing in private real estate funds.
Okay, excellent. I know you probably answered this earlier, but what are some common types of documents and legal frameworks used for private
Mm.
funds?
Yeah, so it's an important thing to sort of be a little bit aware of, because it just lets you know the type of documentation that you're going to have access to as an investor. So there's a few different ways that private funds can raise money. The most common is basically only from high net worth individuals, which is called the accredited investor exemption. So if you're investing in a standard private fund using the accredited investor exemption, you're going to be getting the limited partnership agreement, which is the agreement that sort of is made between you as an investor, a limited partner, and the fund, which basically outlines what the fund can do with the investor's money. How does that work? Are there redemptions? When can you expect to get your money back out? All these sort of things we've talked about, those will be outlined in that limited partnership agreement. You should also get a term sheet or like a summary fact sheet or something like that. That's going to take some of those core details out of that, 50-page document and put them on a one pager so you can see kind of quickly what those are. So potentially you'll have a term sheet that you can sign, but it might not be a binding or a signed term sheet. It might just be a sort of fact sheet to go alongside with the limited partnership agreement. You'll also be able to have the declaration of limited partnership. So with a company, if you're investing in a company, you'd get the articles of incorporation, which is the document saying, this company is real and it's been created. For funds that are set up as limited partnerships with a general partner and then the investors as limited partners, you're going to have a declaration of limited partnership as that kind of document proving that the fund was created. So typically, if you're investing as an accredited investor into a private fund, you're going to be getting the limited partnership agreement, sort of fund fact sheet or a term sheet to be able to review, and the declaration of limited partnership. Then when you actually invest, you'll be signing a subscription agreement, which is basically like a purchase agreement for the shares or the units into the fund. And then there'll be some risk disclosure forms connected to that subscription agreement. So that's kind of all the documentation you'd be getting if you're investing directly into a standard accredited investor only private fund. Now, if the fund is using the offering memorandum exemption to allow more people to invest into them and to allow potentially TFSA RRSP investing, there's going to be a few more documents that you'll be getting. So the first thing is everything that you would get from this first category of accredited investor only, you'll still get that. So there's still going to be the declaration of limited partnership. There's still going to be the limited partnership agreement talking about what the fund can actually do with your money. There's still going to be a subscription agreement that you sign that outlines exactly sort of what you're buying and those details. There's still going to be a risk form connected to that. And there's still going to be most likely a term sheet or a fund fact sheet somewhere that kind of summarizes this detail. When you move to the offering memorandum exemption, though, you're adding in a few additional pieces of documentation that could be quite helpful for you to review as an investor. So the most critical that's being added is the offering memorandum itself. This is basically like a 70-page document that tells you, an investor, everything you need to know about investing in the fund. So it's going to have a lot more details around the use of capital and what they want to do. It's going to summarize certain sections from limited partnership agreement or other locations saying, okay, what can they do or not do with the money? How do the redemptions work? What are your rights as an investor? The big change here also is there's going to be an entire section dedicated to the potential risks associated with investing in this fund, which you wouldn't normally get in a term sheet or something like that for an accredited investor only investment. So the offering memorandum really has this great risk section that I really recommend you have a look at. Another critical thing is raising using the offering memorandum rule set means that funds also need to provide audited financial statements, both at the time you're investing and on an ongoing basis. So If it's a fund just starting out, their financial statements are essentially going to be blank, but they do have a requirement to keep providing those on an audited basis annually. So you can review those now and you'll be able to review them in the future, which is valuable. So having this document is really useful to sort of go through and review and get that sort of additional access to information. Now, I know you didn't necessarily ask this just yet, Ryan, but I think it's important in the context. If the fund is raising using the offering memorandum, and part of their goal is to allow investors to participate with a TFSA RRSP, there's going to be some additional things, some additional documents that you as an investor will be able to look at. And essentially making the fund open for TFSA RRSP investing requires them to use the offering memorandum exemption, but also requires them to change the fund structure somewhat. So a standard private fund is a limited partnership where you are an investor, you're a limited partner, and the managers of the fund are the general partners. So they're basically controlling what happens with the money, and limited partners are the one who earn the majority of returns, and then you pay like a fee to the general partner. That's a sort of standard private fund structure. Now, when you're looking to allow TFSA or RSP investing, you need to change things around a little bit. So it's not going to be just that standard limited partnership structure. That will still be there as the core sort of operational fund, but there's a layer that has to be kind of added on top to allow the TFSA RRSP investing into the fund. And that would be setting up a trust. So essentially, for a variety of reasons, you can't invest directly using a TFSA or an RRSP into a limited partnership. It's not eligible as a TFSA or RRSP investment. And so a trust is set up basically as that sort of buffer. And the trust exists purely to take your money and invest it directly into the limited partnership. But it's just important to know that there's going to be this additional layer. So when you're investing, you're not buying limited partnership units in the underlying fund. What you're buying are trust units. And so the additional documents you're going to see would be the declaration of trust. So it's going to be like the articles of incorporation for a company or a declaration of limited partnership. It's going to be the document that actually creates the trust. And when you're reading the offering memorandum is going to talk about the trust and your investment into the trust. And then it's going to talk about what the trust is doing with your money, which is investing it directly into the limited partnership. And then it's going to talk about what the limited partnership, the actual fund, is going and doing with your money. And so you're going to get a few additional documents associated with the trust itself. Now, typically, the fund managers are also going to be the trustees of the trust, just to keep everything sort of simple. But in terms of a flow, you as an investor are actually investing into this trust, and then the trust is going to immediately invest into the limited partnership, which is the fund, and then the fund is going to go out and invest into the different investments. So when you're looking at all the documents, for example, if you're investing through Equivesto and you're investing in a fund that's using the offering memorandum exemption, when you're signed in, you scroll the bottom to look at the documents, you're going to see, okay, there's going to be the sort of fund fact sheet or the pitch deck or something like that. There's going to be the offering memorandum itself. And then there's going to be the declaration of limited partnership, the limited partnership agreement, and then the declaration of trust, all these additional documents sort of providing you details on those sort of additional layers. When you sign your subscription agreement as well, again, you're buying those trust units. So you're not actually investing into the fund, the limited partnership itself, you're investing into the trust, and then the trust exists purely to sort of go ahead and invest your money straight into that limited partnership.
Alex, could you go into more detail about TFSA and RRSP investing?
Yeah, it's an important topic, Ryan, and a lot of people are interested in using TFSAs, RRSPs, LIRAs, and all different types of registered accounts to be able to invest into private investments. It's definitely possible to do, but there are some important things that investors need to know. The first thing is that normally your TFSA, RRSP, or other registered account is held at one of the large five banks, typically TD, RBC, BMO, Scotiabank, or CIBC. And the investment and the advisor and the TFSA is all sort of done in one location. And typically, because the bank is making money on you in other ways, they don't charge you specifically for, the registered account. Now, private investments are not automatically TFSA or RRSP eligible like public investments are, investments traded on the stock market or anything like that. And so additional work goes into confirming these private investments as TFSA or RRSP eligible. Now, the big banks that have these, the vast majority of these TFSA and RRSP accounts aren't necessarily interested in spending the time to verify all these smaller investments or private companies. And therefore, they don't do that. What that means, though, is you can't use your TFSA or RRSP with these big institutions to invest into these private investment opportunities. That means we need to work with something called a trust company. So a trust company is a company that specializes in managing these registered accounts and managing investor funds on behalf of investors for private investments. Now, this is not the same as an exempt market dealer or an advisor like Equivesto is. Basically, this is just an account creation location. So they help create TFSAs and RRSPs, and they hold your TFSA and RRSP for you, but they're not the one you're actually doing the transaction through, if that makes sense. So if you're coming to invest in a private fund, you need to still use an exempt market dealer like Equivesto to make your investment, but where the investment is held is in your TFSA or RRSP with one of these private trust companies. Some of the larger names in the space would be Olympia Trust or Western Pacific Trust Company or Odyssey Trust. So these institutions are actually the location that you have to create an account and have your funds held there. Now, because the institution, the trust company, doesn't make any money any other way, they charge fees to both the companies to get verified and to the investors for transactions and to have accounts. And so because of these additional fees, it's important to keep that in mind when making your investment, as the tax savings from using a TFSA or RRSP need to be larger than the associated costs of those fees from the institution for it to be financially worthwhile. So how does the process actually work? So before you can even make an investment, the company has gone and paid some fees and done some paperwork in conjunction with the EMD, typically Equivesto, to make sure that they are TFSA or RRSP eligible. So they've gone and done that work to get set up with the trust company. Once that's finished, then the page on Equivesto will be updated to reference that it is TFSA or RRSP eligible. Now, it's important to let the exempt market dealer or to let Equivesto know in advance before you initiate your transaction, because the paperwork that you need to sign and what happens with your money is going to be a little bit different if you're investing via a registered account. So let's say you have your RRSP with RBC and you want to invest in a private fund on Equivesto and you want to use money from your RRSP. How is that going to work and what's the process going to look like? So we try to make the process as simple and smooth as possible, but there are a few steps. So the first thing is you're going to get your account created and approved on Equivesto. So you're going to sign up, complete the onboarding forms, and get approved and get your limits provided. Once that's done, you're going to let Equivesto know, hey, I want to make an investment in this private fund using my RRSP. And I don't have an RRSP with whichever trust company the fund is working with. We now know to give you some different paperwork to help set that up. We are also not going to directly collect any funds from you as if you were investing in cash. If you were investing in cash, we would be collecting the money from your bank account when you were signing the investment documents. However, because you're not investing in cash and the funds need to move to your new RRSP with the trust company, we're not going to actually touch any of that money. So you've let Equivesto know, hey, I want a new RRSP with the trust company. When you go and you sign your investment documents, the package of documents is also going to include a few additional documents. It's going to include the new RRSP document, the account creation document for the trust company in there. It's also going to include a letter of direction, which is essentially telling the trust company that you're working with us and you'd like to make an investment afterwards into this fund. And then it's also going to include a letter of authorization, which is authorizing Equivesto to speak to the trust company on your behalf. And finally, it's going to include a transfer form. And that transfer form is going to include all the details so that the trust company can reach out to RBC and tell them, okay, what money needs to be moved from where in your RRSP over to the trust company without it being a withdrawal from your RRSP. It's an RRSP to RRSP transfer. So once all those documents are signed and submitted, Equivesto will, on your behalf, reach out to the trust company and help get your account set up and help shepherd the account through the entire transfer process. A few things to keep in mind about the transfer. Inside your RRSP, your money is not just magically in the RRSP. The RRSP is the account type that is holding your investments, but the actual RRSP, the money inside the RRSP, is in a number of different investments, probably a selection of other mutual funds. So when we prepare that transfer form, it's going to be very important that one, either you have gone to your bank in advance and said, hey, without withdrawing any money from my RRSP, I'd like you to sell some of these investments and hold the funds in cash inside my RRSP. Or on the form, on the transfer form, you indicate which investments in your existing RRSP you want to sell. Because if your RRSP is invested in sort of 15, 20 different funds in different varying amounts earning different returns, we don't know what you want to sell. And the trust company doesn't know what you want to sell. So you need to tell us so we can tell your bank, okay, sell 50 units of TD fund number 1 and 60 units of TD fund number 2 to get a total of $50,000 to then transfer over to the new trust company. So it's important that we know the number of units and what fund specifically they're in and the fund code that you want to transfer them from to make sure the process is smooth. You can, of course, as I mentioned, go directly to your existing institution and have them sell those units and hold them in cash. None of this is leaving your RRSP. It's still within your RRSP, so you're not doing a withdrawal. There's no tax implications, but we just want to make sure we know exactly what's being transferred. Another important thing to keep in mind is most large institutions have a transfer out fee. You know, the banks are happy not to charge you to have accounts with them as long as the money is something they're managing. But as soon as you want to remove the money from TD or RBC or wherever, there's going to be a transfer fee. And these range from $100 to maybe $400 for that transfer out fee. So it's important that you allocate for that effectively. On the transfer form, it tells the bank, okay, please transfer net $50,000. So at the end of the day, $50,000 should be arriving at the new trust company. But the banks never do this. They sell $50,000 and then they take their fee out and transfer what's left. And so oftentimes we'll have clients making a $50,000 investment. 50,000 will be sold and transferred, and $49,600 arrive. And so now you're $400 short for your new investment. The banks aren't necessarily very happy that you're taking money out of their sort of family of investments. And so they sometimes make it a little bit harder. So you want to kind of keep that in mind that those things will be involved. On the side of the trust company will now have created your account and will have submitted that transfer form. Now, transfers between institutions like this can take 4 to 6 weeks, sometimes even longer, because these are sometimes paper-based and sometimes have a little bit challenges. But feel free to follow up with the Equivesto team if you have any questions about your transfer process. Once the funds actually arrive at the trust company, you will then be included in the next closing. But don't worry, the moment you signed your investment documents, your position in whichever investment was secured. So even if the closing, is happening or the investment becomes full, your space is saved because you signed those investment documents, and the closing will take place whenever the funds do arrive. Now, we did mention that these trust companies do charge fees. So it's very important to review and understand what those fees are. We have the fees located on the Equivesto website when we get updated details on them, but you can also check the trust company's website themselves. Typically, we see an annual account fee of between $150 and $200 plus tax. And we typically see a transaction fee, which is a one-time fee of around $80 plus tax. We'll also sometimes see a document processing fee of $20 to $25. So the first time you make your investment, you're probably going to be charged somewhere between $350 or so, maybe a bit less, maybe around $300 for the investment that you're making. And then annually, you will be charged that annual account fee as well. That will be probably around $200. We recommend clients provide a credit card to pay these fees to the trust company so that the fees aren't coming out of the money that you've reserved for your investments. In terms of the closing process and everything, we're not directly collecting the money from you. The money's moving from your existing institution into Olympia. And then the closing, when it takes place, typically at the end of the month, will happen once your account is funded. And then Olympia will move those funds on our direction and on the direction of the fund or the company to the company. Now, you will get your transaction account summary and sort of different documents from Equivesto, but Olympia will also, or the trust company, will also provide those account statements to you on an ongoing basis. Remember, the platform is really the location where the transaction is taking place and the record of that transaction is, and the trust company is where those funds are actually held forever. So when the investment is done and you want to take your money back out, that'll all be with the trust company. Equivesto is here to try to make the process as easy as possible for you. So we've included all of the documentation in the Equivesto process, and we submit and manage that process with the trust company. But you should also be getting your own account access documentation and information so you can access your account directly once your account has been set up. If you have any questions about this process or how it works, please feel free to reach out to the Equivesto team because it is a little bit complicated.
So what are the typical investment minimums to participate in a fund?
It's a great question. It really does depend on the structure. Typically, private funds have investment minimums somewhere between $100,000 and $25,000. We see $50,000 as kind of the go-to number these days. But if that fund is specifically looking to allow greater accessibility and allow more Canadians to access that fund, they'll lower their minimum sometimes to $10,000, sometimes even to $1,000. So there's certain funds on Equivesto that are really focused on allowing more Canadians accessibility to private investments, and that's why we like to work with them. And they have a minimum investment of like 1,000, some are 2,500, some are even 504. So there's really kind of a range. You'll need to review the offering page of the fund to confirm if it's accredited investor only or if it's offering memorandum, and then if so, what the minimum investment is.
Awesome. And where can somebody look to find private fund investment opportunities in Canada specifically?
Yeah, so private funds are sometimes hard to sort of come across. Obviously, you'll probably see them posted on their own website. You might see some referenced on social media, but you need to make sure if any fund is kind of out marketing to you, they need to be working with a licensed exempt market dealer to be able to do that if they're a private fund. Essentially, exempt market dealers like Equivesto are licensed sort of intermediaries who are designed to help make sure that all the information the investor needs about the fund is made available to them, including, confirming that the fund is legit. And then on the flip side, working with the investor to make sure the investor gets the information they need about their suitability and everything, so they know, okay, does investing in this fund sort of make sense for me, and make sure the entire transaction meets the different securities law requirements. So you can look for different online investment platforms or exempt market dealers like Equivesto to see, okay, what private funds are out there, and can I invest in them?
And how exactly do I know that a private fund is trustworthy or legitimate? Because say I see it on social media, I click the link. What details should I actually look for?
Yeah, and this is important because there's, with social media, there's a lot of information out there. You want to make sure you're looking at something legitimate. So really you want to be, so you see an ad, you go to a funds page or something like that. You want to see a reference somewhere that they're working with an exempt market dealer, or there's some sort of licensed entity that's involved with their capital raising efforts. If you don't see something like that, that might be a little bit concerning. So you definitely want to check for that. It might be in sort of like the fine print at the bottom of the page or something like that. Also, when it takes you to a location to actually transact, where you're finally sort of making that investment, you want to see, okay, is this an exempt market dealer location? Where am I actually sort of going to make this transaction? So if you're on a page of an exempt market dealer, you want to verify that they're actually licensed. There's a Canadian government website called Are They Registered, which you can go to actually confirm, is this exempt market dealer licensed? Are they licensed in my province? So can I actually work with them? And is all of their registration sort of up to snuff? I think we have a link to that government website on the Equivesto website in our learning center as well. We have a page on exempt market dealers that you can check out.
Okay, perfect. I think we're gonna take a pause right here, and kick off the company discussion next week. Thank you.
Perfect. Thank you.